Good morning. Thanks for coming. It's my pleasure to present my work here. So the topic I'm going to present today is implicit government guarantee. So what is implicit government guarantee? So basically, it is a guarantee that provided by governments and enjoyed by financial institutions. It is implicit because there's no ex-ante promise that the government will come into the rescue of financial firms. However, bailouts happened before during financial crisis and will certainly happen again in the future. So although it is implicit, it is also very real. Then how is this implicit guarantee relevant? Why is it important? Let's start with Mr. Gardner. 3 years before the subprime crisis, he emphasized that an overly generous financial safety net contributes to financial crisis. The financial safety net he mentioned includes both explicit guarantee, such as deposit insurance, and also implicit guarantee, which is enjoyed by the so-called too-big-to-fail firms. 3 years after the financial crisis of 2007, Mr. Bernanke talked about the too-big-to-fail problem and regarded it as the most important issue we need to address. The too-big-to-fail problem is actually the moral hazard problem resulted from implicit guarantee. 2 years later, Mr. Carney further confirms that the moral hazard problem is positively related to the probability of distress. So, what is moral hazard? In the movie Wall Street 2, a little old lady asks Mr. Gecko, what is moral hazard? And this is his answer. Apparently, this is not the correct definition of moral hazard. This is wrong. But you still get the idea that moral hazard is wrong and should be corrected. To summarize, implicit guarantee leads to moral hazard problem, which is a critical contributor to financial crisis, especially the most recent ones, according to these guys. Because implicit guarantee is so bad, can we simply eliminate it? Well, it is extremely difficult, if not impossible. Not only because government intervention during crisis is politically convenient, but also government bailouts can generate economic benefit, according to Varnese and Zinger's 2010. If we cannot stop bailouts, we cannot completely remove implicit guarantee. Therefore, we need to figure out how to live with it. Actually, there are many solutions on the table. Although implicit guarantee gets more and more popular after the 2007 financial crisis, it is not new. It has been there for a very long time. But before and during the 2007 financial crisis, the main solution to the implicit guarantee issue is called constructive ambiguity. So what is constructive ambiguity? Let me give you an example. During the 2007 financial crisis, the US government bailed out Bear Stearns, but did not bail out Lehman Brothers. There might be other reasons, but this policy inconsistency and this ambiguity was meant to reduce the market expectation of government bailouts. However, it turned out that this constructive ambiguity didn't work well. So it was not effective. Therefore, many other solutions are suggested or are implemented during and after the financial crisis. So, what are the solutions to implicit guarantee? One solution could be we stop firms to become too big or too systemically important. So we have constraints on bank size. So this is a proposal. It's not implemented, but it could be one solution. Or we could refinancing the commercial banking, the retail operations of commercial banks. If we cannot stop banks or other financial firms to become systemically important or to become too big, then probably we should reduce the risk of default. And one solution is to ask banks or other important financial institutions to have extra capital buffers so that the default risk decreases. And if we cannot stop banks from defaulting, then probably we want to internalize the cost of the default. One solution is the so-called hybrid capital securities, which is the COCOs. Probably most of you are familiar with. And this is called built-in arrangements. Or we could simply tax banks on the implicit guarantee they enjoy. And for all of these measures, all of these solutions, the first step is to measure the magnitude of implicit guarantee. So, what is the implicit magnitude in France? So, with these motivations, I intend to address the following questions. First, I propose a method to measure the magnitude of the implicit guarantee. And by definition, implicit guarantee is positively related to a firm's size or its systemic importance. Does empirical analysis support this theory? Do we find too big to fail problem? This is the second question. In Achaya, Angela, and Verton 2013 paper, they studied the insurance companies and banks in the United States. And they found that implicit guarantee exists for banks, but not for insurance companies. This is difficult to believe because the US government actually rescued AIG during the crisis. So this makes me curious, and I investigated the question with European financial firms. Another question is, as a major response to the recent financial crisis, does Basel III do a good job with respect to reducing implicit guarantee? Next, compared with the rest of countries in the European Union, Eurozone countries are more integrated in both economic and monetary dimensions. Does this mean something to implicit guarantee? Finally, I'm also interested in the relationship between implicit guarantee and home country's credit risk. So we are going to answer each of these above-mentioned questions in the following talk. We start with some literature review. So the paper actually is inspired by a 2013 paper of Black and others. And I intend to measure the implicit guarantee using the price differential of the two types of CDS contracts for the same firm, which are senior CDS and subordinated CDS. The idea is that if senior debt enjoys implicit guarantee and subordinated debt does not, then this difference should be reflected in the pricing of these two CDS contracts. And if this is the case, we can measure or we can calculate the implicit guarantee from these two types of CDS contracts. Okay, the price of these two types of CDS contract. Then the question becomes, is this true? Is this true that only senior debt enjoys implicit guarantee? The first evidence supporting this argument is that academics and policymakers have long been encouraging banks to issue subordinated debt for market discipline, which means that subordinated debt is not covered by implicit guarantee. Otherwise, it will not be sensitive to risk. And to further convince you that this is the case, we look at the historical default events. Moody's Investor Service 2009 argued that in Europe, governments only bail out senior debt, but not subordinated debt. And this is further confirmed by a 2012 study of OECD journal that the holders of unsecured bank debt other than subordinated bonds have typically been exempted from loss sharing, which means that senior debt enjoys implicit guarantee, while subordinated debt does not. And we also have a recent example, which is the nationalization of SNS in 2013. This is the first largest bank in Netherlands. And during this nationalization, only subordinated debt was seized by the government in exchange of bailout package, which means that the senior debt holders didn't suffer, while the subordinated debt holders suffered. In addition, if the argument is true, then we will find evidence that the spread of senior debt is not sensitive to risk because it's covered by the implicit guarantee. So investors do not care about risk. But subordinated debt holders, the subordinated debt spread is sensitive to risk because it's not covered by implicit guarantee. So we look at the literature. In general, the literature supports this argument, and at least after the 1990s. So there are three different time points. So this is early empirical studies. They find that even subordinated debt do not have market discipline, which means even subordinated debt is not sensitive to risk. But after the 1990s, literature finds that market discipline exists for subordinated debt. And more recent studies show that market discipline exists for subordinated debt, but not for senior debt. However, there are different voices. Okay? So I have to admit that the findings in my paper is compromised to the extent that subordinated debt is also covered by implicit guarantee, although there's no much such evidence. My paper is directly related to prior studies with the intention of quantifying implicit guarantee. So there are four approaches in the literature to measure implicit guarantee. The first approach is ratings-based approach. The second is the basket index put spread, which uses option price information. And also we have contingent claims analysis approach, which relies on equity price and senior CDS spread. Lastly, we have bond spread differential approach, which is actually the spread risk analysis. However, none of this focuses on Europe, and none of this investigates the two segments of CDS markets. And also, there are some drawbacks for each of this approach. For the ratings-based approach, the ratings-based approach reflects only the long-run relationship between credit ratings and the yield, the bond yield.
You mean like long-run?
Long run, there are two layers of this long-run relationship. First, because as you know, credit ratings are through the cycle. So usually it's not time varying because we want the credit rating to be stable over time. And second, to establish relationship between credit ratings and bond spread, we need to use long-term data to calculate, to transfer credit rating to bond yield. And this could be very noisy for short term. So if we want to measure implicit guarantee in a reasonable frequency, probably it's not good to use this approach. And the contingent claims analysis, because the contingent claims analysis uses equity price and senior CDS spread. And because implicit guarantee encourages banks to take higher risk, which translate into higher return during good time, this inflate the equity price, which underestimates the implicit guarantee, the implicit subsidy. Okay. And the bond spread differential approach, because this approach relies on regression analysis. So they want to find out the relationship between implicit guarantee, between bond spread and risk. Okay? And in order to do that, we need to control a lot of other factors so that the relationship is real between spread and risk, not between spread and other factors. And sometimes the variables are too many to control. Also, for this approach and the basket index put spread approach, they can only be applied at the aggregate level, not at firm level. However, financial firms should be treated differently if they indeed enjoy different implicit guarantees, which makes it important to be able to measure individual implicit guarantee and firm level. And my method can do this job. Okay? I'll show you from next slide how I measure this implicit guarantee. So if we decompose CDS spread as a product of risk-neutral probability of default and risk-neutral loss given default, I argue that the implicit guarantee is reflected in the differing PDs calculated from the two CDS contracts. In other words, assuming fixed loss given default for both senior debt and subordinated debt, without implicit guarantee, the risk-neutral PD calculated from the two different CDS spreads should be identical. Northern and Weber 2012 make the same assumption without explicitly telling why. And this assumption is also consistent with the approach adopted in Longstaff and Swalsh 1995. Here, we can go a little bit further. So if we look at this equation, so now I'm going to explain to you why risk-neutral PD probability of default should be equal without implicit guarantee. So risk-neutral probability of default is equal to physical probability of default plus risk premium. And the physical probability of default is the same for both subordinated debt and subordinated CDS and senior CDS due to the cross default provision. So if you default on one type of debt, you default on all debts. Okay? So the physical default, probability of default is identical. Now the question is, how about the risk premium? If the risk premium is again identical for the two types of CDS contract, then we can say that without implicit guarantee, the risk-neutral probability of default is identical. Risk premium can be decomposed as default risk premium and the liquidity risk premium. For now, let's just focus on default risk premium. Default risk premium compensates for the variation in physical probability of default. And I just showed that physical probability of default is identical for the two types of CDS contracts. Therefore, the default risk premium is identical for the two types of CDS contracts. Now, how about the liquidity risk premium? Unfortunately, liquidity risk premium could be different for the two types of CDS contracts. However, empirical studies suggest that the liquidity for the two CDS contracts is almost equal during the financial crisis. And I'll come back to this in a few slides. So to summarize, because senior CDS is covered, senior debt is covered by implicit guarantee. Therefore, the probability of default extracted from senior CDS is the subsidized PD, is polluted by the implicit guarantee. And the probability of default that is calculated from subordinated CDS, which is not covered by implicit guarantee, is the real PD, or the fair value PD. Okay? So now we have two different PDs. One PD, we calculate it from senior CDS. Another PD, we calculate it from subordinated CDS. And because senior CDS is covered by implicit guarantee, therefore the PD calculated from senior CDS is subsidized PD. It's not a fair value PD. It's lower. And the PD calculated from subordinated CDS, which is not polluted by implicit guarantee, is the fair value PD, or the real PD. Okay, so now we have these two PDs, and we're going to use these two different PDs for a single firm and each time point to calculate implicit guarantee. And one could argue that actually the difference is not in PDs. The difference is in loss-given default. Sometimes this may seem more reasonable. So if you rescue a bank, if you rescue the senior debt holder, you compensate part of their losses. So this changes the loss-given default rather than probability of default. However, if we look at this equation, okay, so if we go one slide back, so approximately the CDS spread is equal to the product of probability default and loss-given default without implicit guarantee. So this is for subordinated CDS. For senior CDS, because of the implicit guarantee, there is a discount factor that lowers the CDS spread. So it becomes like this. And as you can see that probability default and loss-given default, they're symmetric. So if we combine the discount factor with the fair value of probability of default, we have a new probability of default, which we call it subsidized probability of default. You can do the same. If you combine the discount factor with loss-given default, the fair value of loss-given default, you will have a subsidized loss-given default. This will not change our results, okay? But we just stick to that we assume that the influence is on the probability default. We keep loss-given default unchanged. Okay? And also, government bailouts that reduce loss-given default is effectively equivalent to reducing the probability of default, keeping loss-given default unchanged. Okay? So, now we need to calculate, okay, in order to measure or compute the implicit guarantee, we need to calculate both probability of default and also the asset correlation. You know why we need to calculate the probability of default, but you don't know yet why we need the asset correlation. I will tell you in next slide. But for now, how do we calculate the probability of default? So the probability of default is calculated from the CDS spread with simplified Duffy model. So we simply equate the two legs of a CDS contract, the premium leg and the protection leg. And then we can calculate this probability of default. And the asset correlation is proxied by equity correlation, which is estimated with a factor DCC model. Okay? So this factor DCC model is designed to deal with high dimension problems, such as the one in this paper. So we have many firms, so the dimension is high. The usual correlation model cannot do the work, so we use a factor DCC model. Okay, I will not go into details of this, and if you're interested, we can certainly talk about this later. So after we have this, okay, we have probability default and asset correlation. Now we're in a position of computing implicit guarantee. Roughly speaking, implicit guarantee is the difference between real expected loss and subsidized expected loss for senior debt holders. Okay? And to calculate real or fair value expected loss, we use the, to calculate the real expected loss or fair value expected loss, we use the probability of default that is calculated from subordinated CDS. And to calculate the subsidized expected loss, we use probability of default that is calculated from senior CDS spread. And then we have this indicator function, which is an indicator for financial distress. Why we have this is because implicit guarantee is only realized when the whole financial system is in distress. Okay? Without a financial crisis, there's no implicit guarantee. Implicit guarantee only exists if we have financial crisis. So this indicator is equal to 1 if we have a financial crisis. Okay? That's why there is this indicator here. And in order to calculate this indicator function, we need asset correlation. We need to simulate correlated asset returns for all financial firms so that we know when there is a crisis or not. Okay? So this answers the question why we need asset correlation. Okay? We need asset correlation to calculate this indicator, to know whether it is in a financial crisis or not. Okay? Then we use Monte Carlo simulation to calculate this expectation. So we have individual implicit guarantee. And the aggregate implicit guarantee is simply the weighted average of individual implicit guarantees across all financial firms in the sample. Okay? To summarize, we observe difference between the spreads of senior CDS and subordinated CDS. The difference comes from, first, the different loss given defaults. Okay? If we control for that, then the rest is the implicit guarantee. So for single financial firm and a particular date, we can calculate a probability default, which we call fair value probability default, from its subordinated CDS spread. We can also calculate another probability default. We call it subsidized probability of default, which comes from the senior CDS spread. With these two differing PDs, we can calculate implicit guarantee. Sample selection. So we start with 100 largest financial firms in Europe. And then I apply these two criteria to the sample to make sure that we have liquid CDS spreads and liquid equity price. And then I end up with 46 firms. 35 are banks, 11 are insurance companies. The data is collected from Bloomberg. Now let's look at some empirical results. So first, CDS liquidity. Remember, we argued that the liquidity is almost equal for the two CDS contracts. So in order to show that, I use relative bid-ask spread to proxy liquidity, as in Northern and Weber, 2010. So I expand Northern and Weber's work in several ways. So first, I expanded their time period to cover the most recent two crises. This is the first graph. As you can see, the median relative bid-ask spread for the two CDS contracts are indeed almost equal during the financial crisis. Okay? And the second, they only investigated the median. I look at the more complete picture by also looking at the upper and the lower quantiles of the distribution. So this is the up quantile, this is the lower quantile of the distribution for the senior CDS, relative bid-ask spread, and subordinated. As you can see, again, they're almost equal during a financial crisis. In addition, to account for the possible size effect for liquidity, I also compare the weighted average, the liability weighted average bid-ask spread. This is the graph 2. So as you can see, all of them tell the same story, which is that during the financial crisis, the liquidity for senior CDS and subordinated CDS are indeed almost equal. The aggregate implicit guarantee in the financial system. As shown in the first graph, the graph on top, the evolution of the aggregate implicit guarantee is consistent with several critical events, such as Bear Stearns bailout, Lehman Brothers failure, Greek bailout, and it is its highest level during the sovereign debt crisis. Comparing banks with insurance companies, in the second graph, in the graph below, in general, they move in the same direction. Okay? So, in contrast to the findings in Achaya, Angela, and Verton, I do find substantial implicit guarantee for insurance companies. On the other hand, I agree with them that banks obtain higher implicit guarantee compared with insurance companies. As you can see, the blue line is banks, is higher than the dotted red line, okay, especially during the sovereign debt crisis. Is this because banks are more important than insurance companies? Or simply because banks are more risky than insurance companies? I leave this question to be answered later with regression analysis, yes.
Sorry, I go to the figures. Can you describe the price?
This is the time.
Yes,
okay.
And the price varied from before the crisis.
At individual level, I divide the sample period into pre-crisis period and two crisis periods. As you can see, there is great variation both over time and cross-sectional. So it increases dramatically over time, and the maximum and the minimum are quite different. Okay? So there is great variation among financial institutions. And this is confirmed by the ranking of top 15 financial firms. As you can see, over time, the rankings for each financial firm is different. So it's time varying. On the other hand, there are 8, well, maybe you cannot see it clearly, but there are 8 financial firms remaining top 15 since 2010. Okay? They are marked with red color. So these 8 financial firms, they are always among the top 15 after 2010. And this raises the question that whether it makes sense for regulators to focus on a list of a few financial firms. And to answer this question, I look at the concentration of implicit guarantee. And as shown in this graph, it turned out that the top 10 firms accounts for the majority of implicit guarantee, about 60% over time. This finding supports the idea that we can focus on a small group of very important firms to manage implicit guarantee. I also calculate a distressed version of implicit guarantee, and I call it DIGG. So the distressed implicit guarantee is simply the conditional implicit guarantee. Conditional on the financial system is in distress. So this measure provides additional information because it is the subsidy provided to senior debt holders when a crisis strikes. And this table, in this table you have both implicit guarantee and distressed implicit guarantee in 2007 and 2011. As we can say, implicit guarantee increases dramatically from 2007 to 2011. Distressed implicit guarantee also increases, but to a much less or to a much smaller extent. As a conditional expectation, distressed implicit guarantee is far larger and more stable than implicit guarantee. And also, this table gives another piece of information. That is, in 2007, although the implicit guarantee is quite low, as you can see, it's very, very low, okay? But the distressed implicit guarantee is fairly high already, okay? So this means that regulators may be interested to also monitor the distressed implicit guarantee. Okay? Do we find too big to fail problems? Do we find too big to fail issues? We do this analysis with regressions. So in these regressions, the dependent variable is implicit guarantee. The PD is a proxy for default risk. Interconnectedness is average correlation between one bank and other banks in the sample. VIX is a common proxy for market fail, for market risk aversion. Size is total log asset. Size is log total assets. Top 10 is a dummy variable representing the 10 largest firms in the sample. Similarly, bottom 10 represents the smallest firms in the sample. As you can see, the coefficients of size and the top 10 are positive and significant in the single regressions. And also, after we control for default risk, interconnectedness, and market risk aversion. So we find a positive coefficient here, 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 and here. And the negative coefficient of bottom 10 is also expected, which means we do have too big to fail effect here. So the larger the bank, the higher the implicit guarantee it enjoys. We are also interested in the interaction term multiplying top 10 with default risk. In fact, higher default risk does not necessarily lead to higher implicit guarantee unless the institution is systematically important to some extent. In other words, we would expect that for a more systemically important bank, such as a top 10 bank, its implicit guarantee is more sensitive to its default risk, which means we expect positive coefficient of this interaction term. which is exactly we find in here. Okay? And besides the size effect, we are also interested in the bank dummy and the Basel III dummy. The bank dummy is positive in here, 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 and here. Okay? And since we control for default risk, so banks have higher or obtain higher implicit guarantee, not because banks are riskier, because we already control for the default risk. So this is because banks are perceived more important than insurance companies. And the Basel dummy, the positive sign, the positive coefficient of Basel III indicates that Basel III has not solved the too big to fail problem. Regarding why it seems that after the announcement of Basel III, the implicit guarantee has been enhanced. Well, one possible explanation is that the more stringent regulation of Basel III may be perceived as the further justification of future bailouts whenever needed. There might be other factors that are driving these results. So this may not be Basel, but clearly Basel has not eliminated the implicit guarantee. Okay? And also because Basel only works on banks, and my sample includes both banks and insurance companies. So I do another regression analysis with only banks, and the conclusions are exactly the same. We conduct several robustness tests. So first, I jump the largest 5 firms from my sample to say whether the results are driven or biased by extremely large firms. Also, there might be some variables, observable or unobservable, that I miss in original regressions. So I also include both firm fixed effects and time fixed effects. Lastly, I focus on 2 financial crises separately, subprime crisis and sovereign debt crisis, to investigate the possible difference between these 2 crises. In general, my results survive the robustness tests. However, I do find that the too big to fail problem is more prominent during the sovereign debt crisis compared with subprime crisis, both economically and also statistically. This may indicate that the sovereign debt crisis is a more severe scenario for European countries compared with the subprime crisis, which is originated in the US. So this is the interest rate for Eurozone countries. As you can see, after the establishment of Euro area, Eurozone countries or Euro area state members exhibited similar and low interest rate. This is another form of implicit guarantee. It's the implicit guarantee, for example, from Germany to Greece. Okay? This is the implicit guarantee at country level, unlike the one in my paper, which is at the firm level. But this makes me think that maybe Euro area also has some implication for and the firm level. So I do the analysis. I compare financial firms in Euro area with financial firms in non-Euro area, but also within the Euro. Okay? So, as you can see from this statistics table, Eurozone financial firms obtain higher implicit guarantee, both during the whole sample period and also in the pre-crisis period and the crisis period. Okay? This finding is not surprising because the failing of a Eurozone financial firm may have more ramifications within Eurozone compared with non-Eurozone financial firms due to the fact that Eurozone is a more integrated economic and monetary union. Let's look at the interaction between implicit guarantee and home country sovereign risk. As contingent liabilities to the government, implicit guarantee increases sovereign credit risk. Right? So the implicit guarantee is actually contingent liability of the government, okay? Because the government would need to rescue or bail out financial firms. This will increase the credit risk of the country. So higher implicit guarantee leads to higher credit risk, sovereign credit risk. On the other hand, sovereign credit risk decreases implicit guarantee due to the fact that the government, it is difficult for government to subsidize financial firms if its own credit condition weakens. So this is a theory. And in order to test this, I do granular causality tests. However, I only find unidirectional relationship from implicit guarantee to sovereign credit risk, but not from sovereign risk to implicit guarantee. This is a little bit strange, but if we take a further thought about the relationship from sovereign risk to implicit guarantee, which is missing in the granular causality test, there are actually two offsetting effects. In addition to the attenuating effects we just mentioned, there is another enhancing effect works directly through the default risk of financial firms. And these two effects offset each other. Hold heavily sovereign debt on their balance sheet. So this increases the default risk of financial firms. Okay? So as sovereign risk increases, the bond value, the sovereign bond value decreases, which is held by financial firms. Therefore, the default risk of financial firms increases. This pushes up implicit guarantee. So these two effects offset each other. That's why we find insignificant result in here. Is this true? Is this the case? So to disentangle these two offsetting effects and isolating the enhancing effect works through the default risk. I do this regression first. So I regress sovereign CDS, right, on the default risk. And then I use the residual, okay, which is a part of sovereign default risk that is orthogonal to default risk. And then I use this residual to do granular causality test again. Now we have the bidirectional feedback effect between implicit guarantee and sovereign credit risk as expected. Okay, so we isolate one effect, we use the effect left, we use the residual to do granular causality test again. And now we have what we expect. So namely, the implicit guarantee increases sovereign default risk, and sovereign default risk decreases implicit guarantee. So to summarize, so I pretty much covered everything here. So the first is implicit guarantee exists for both banks and insurance companies. Banks benefit more. Okay, banks obtain more implicit guarantees. And then the aggregate guarantee increased substantially during the crisis and peaks at an average of 19 basis points around in September 2011. If we translate these basis points into euro values, it is 175 billion euros. This is very large if we compare it with Poisson's plan in 2008, the Poisson's plan injected 125 billion US dollars into the US banking system. And that bailout bears interest and will be repaid when banks exit the program. But this is for free. So this is very large. Okay? And we find that the implicit guarantee is concentrated in a small number of financial firms over time. This supports the idea of focusing on CFIs. Eurozone firms are perceived to be more implicitly protected than its non-Eurozone counterparts. Also, we find that implicit guarantee increases sovereign default risk. On the other hand, there are two offsetting effects from sovereign risk to implicit guarantee. That's all, thank you.